And welcome back. If you qualify for a VA loan, then how do you know whether to do a VA loan versus a conventional loan? That's the topic of today's video. And I'm joined by Jim Black of Revest Homes. Welcome, Jim.
Thanks, Jason, for having me on. I'm excited to be back on your show.
Absolutely. So the reason why we're making today's video is because we had a team meeting about 2 days ago, and you shared an example for a home buyer who got an offer accepted. And he explained the differences between using a VA loan versus a conventional loan. So a conventional loan, you can get down for the minimum down payment of around 3%. Obviously, a VA loan is 0% down payment, but there's the big difference in those types of loans. So we're going to talk about that. So take it away, Jim.
Absolutely. So I'd love to share my screen if that's okay. And in sharing my screen, I'd love to first share this screen. This screen should show you the property in question. Can you see the property, Jason?
Yep. A house in Watsonville, 2-bedroom,
Watsonville,
1 bath,
California. Yep.
27 square feet.
Yep. So this offer price is $529. And what I like about this is there's only a $6 a month HOA fee. If you know any types of properties that are in a planned urban development or a condo situation or townhome, that is very, very, very low. This property specifically is for a 55 or older community. So we love helping seniors. And also in this case, we're helping a veteran. So the veteran in this example was a retired veteran from Vietnam War. And the first question I asked was, thank you for your service. More importantly, are you a disabled or not disabled veteran for the VA loan purpose? Well, in this example, she was not disabled, which means she has to pay the 3% VA funding fee that is required based upon the loan amount. So what was really important to do right away was to determine if conventional or VA was a better way to go, because we know that veterans have to pay that 3% VA funding fee, either by
3% of what dollar amount?
Of the actual loan balance.
Loan balance, yeah. So if you're a disabled veteran, then that's 0%. If you're not disabled, then you have to pay that 3% fee based on the loan amount.
Exactly right. And that fee is either paid by the borrower out of pocket, can be financed into the loan amount, or it could be technically a credit or offsetting credit from a lender or third party. So there's a few ways to do that. Again, with VA loans, if it's a refinance or purchase, it's the same rate. So these rates are actually today's rates on September 12th, 2024. This example I'm giving is a real life example. Please know that you have to qualify for loans, and that if you want to apply for a loan, please work with someone that you trust. So in this example, the purchase price was, we'll just use $530 to round up. $530 is a purchase price. We know that if we're going a conventional loan, it's going to require a small down payment. If we go VA, it requires no down payment, but that 3% funding fee can be financed in addition to the purchase price. So what I wanted to do for our client was show them that they're either going to put 3% down as a conventional loan with no VA funding fee, or put no money down with the 3% VA funding fee financed.
Yeah.
So
basically comparing a conventional loan that has a minimum down payment of 3% versus a VA loan that has a 0% down payment requirement. But obviously that funding fee is only for VA loans. I want to make sure that everyone who's watching today's video kind of understands that.
Absolutely. So I wanted to give two extreme examples to our consumer, like we do to anyone we help, to make sure that they see the differences and benefits of each way, right? Not paying 3% VA funding fee is nice on a conventional loan, but it's also nice to have no money down as a veteran also. So again, I wanted to show them the two comparisons. So let's go to that screen now. I'm going to be sharing now the purchase analysis of looking at a VA and conventional loan. Here is a conventional loan with a sales price of $530, putting down exactly 3%. That rate today would be about 6.5% with an APR of about 6.67%. This again is today, 9/12/24. Borrower's income profile looks like this. So we're looking at their overall payment. There are variables we know that will not change with whatever lender or program you go with. The property taxes here in California are based upon 1.25% of the purchase price. In this example, we have a quote roughly of $125 a month for home insurance. And we know that the HOA fee, which is basically a homeowners association fee, is $6 a month. Whoop-de-doo.
That's the lowest HOA monthly payment I've ever seen in my entire life.
So another thing I did for this borrower is I explained that fee is very low. Most of those fees are $300 to $400 in California. So I was able to share with the borrower also that the difference in spending $300 and $400 a month is about $70,000 in loan amount. So they're actually, in essence, getting a property equal to a condo that should cost $460. They're getting for $530. I wanted to give them that peace of mind that they're not wasting money on monthly junk fees.
Makes sense. You're basically saying that if their HOA was $300 or $400 per month, it's just an added cost that you're paying. In this example, the HOA is only $6. So theoretically, you're saving a lot of money comparing to the same purchase price for a house that has a much higher HOA fee.
Exactly right. So in this example, we have a payment of $3,932. Jason, remember that number, $3,932. This is for the payment in this example is $3,932. And we want to compare this now to what a VA loan would be. Remember, our VA loan we're going after is a higher loan balance, and we're tacking on the 3% VA funding fee in addition to that. So if the rates were the same, conventional would be a better way to go. Well, let's take a look. Now I'm using the VA 100% loan. Sales price is $530. We know the loan amount is $530, but we know the total loan amount is $530 plus 3% VA funding fee. That VA funding fee totals $545,900 with our interest rate of 5.625. That APR is actually more like 5.7. It's much lower on the APR difference.
Just want to make sure everyone's clear on this, just to provide some clarification here. So this is a VA loan. Again, that's 0% down payment, but you're financing that 3% fee that VA charges if you're not a disabled veteran. That's why the total loan balance there is $545,900, which is obviously higher than the $530,000 in that previous example.
Awesome. So now let's go down to see where the magic happens. So the first things we know, I won't give away the secret yet. First things we know, property taxes are the exact same as we saw on the previous screen. The insurance, the exact same thing. HOA, exact same thing. What was that number, Jason? Do you remember that number I told you about before?
3932.
Okay, here we go.
I
feel like I'm on a game contestant show here. Like,
Yeah,
okay, Bob Barker, show us the price
down. Jim Black, you won a new car.
Look at that.
3932 was the payment, the total payment in the conventional example.
And now the total payment is $3,825. So it's a difference, $108 a month savings. So a lower payment by $107 a month, and they're not putting down 3%. And they have a VA loan now that if rates go lower in say 9, 10, 11 months, they can do a VA IRRL loan or VA interest rate reduction loan and refinance at 0.5% for VA funding fee with no appraisals, no lender fees, and a huge savings difference. So we've structured this borrower's loan correctly by giving them a lower payment, again, less money down. And if you saw the property, no offense, if people are looking at this property, I'd probably want to paint the outside of the house a little different color. So now we've given the borrower funds to put into their property that they can now do to maybe fix up the backyard. Maybe they want to have a barbecue here. Maybe they want to paint the house. Maybe they want to put a spa in. Whatever those things are, we've just created now an opportunity for the borrower to save money, to have a lower payment, have a lower interest rate by about 1%, and use a VA tool that I think is very, very powerful and well-deserved for all of our veterans. Remember, if you're a veteran, it means that you're a direct or indirect family member of that veteran. You could be in regular military service, you could be retired or a veteran, disabled or not disabled, or you could have had a special assignment with the government and still qualify. And we find that all that information out on the form that's known as a DD, Dog 224. That's the form that shows all of the borrower's eligibility. If you're a veteran, you know about that document or that card. That's what we use. And so luckily, we'll be able to close this transaction in 24 days, start to finish. The borrower has the funds available to then allow them to have flexibility. And if rates get better or lower, guess what? They can refinance again down the road. So we're doing these veterans a big service, and everyone's happy because the neighborhood has another person that cares, that's passionate about home ownership in their neighborhood. And we all get to help someone that is in deserving need.
Right, that makes sense. Yeah, my biggest takeaway on that is that, looking at the conventional loan, you're putting down what, $15,900. That's a 3% down payment, and your payment is $106, $107 more per month, comparing to the VA loan in which there's no down payment. So you're basically saving $16,000 up front, and your housing payment's less than using a conventional loan. So I was just blown away by that. And like you mentioned too, if rates decrease further, they can have the opportunity to refinance. And that purchasing or that upfront fee from the VA is not 3%; it's actually 0.5%. So you're kind of getting that bigger uptick in that funding fee up front, but you really have a lot of savings on the back
Yeah,
end.
it's really cool. So again, if you're a veteran or have anyone that you know that's a veteran, please get us in touch with them because we'd love to help them. Again, you got to qualify for these things. They're not something that's just like a handout. Again, we love helping seniors, first-time home buyers, and military veterans. It's always an honor to share our passion with those people and make sure that they have the best results, because every lender does not do this the same way. And we want to make sure that we explain the best solution for the decision of the consumer, not us.
Absolutely. I think it's important to provide, multiple options for buyers, because maybe they're still comfortable with doing conventional, but at least you give them the option to choose from. And then for the qualification purposes, since you mentioned that, what is the difference for a VA loan versus a conventional loan?
Yeah, great question. So one of the big,
et cetera.
Yeah, one of the big benefits there is there's no FICO score requirement. So a lot of veterans that are in active military get moved around. They have to get maybe deployed somewhere. They forgot about paying their Blockbuster bill, which no longer exists, but like whatever it might be, right? They have a bill that they maybe missed because it came in the mail or went to the wrong address.
Yeah.
So veterans have more flexibility in their actual FICO score. FICO score plays more of a role with the conventional loans. The higher the credit score, the lower the risk for that borrower to go into deficiencies by their track record of their past. So, and VA does not care. So again, a VA purchase or refinance has the same rate. And those rates are mid fives today, if not low fives. So that's today in September of 2024. Rates change every day. But again, that's really cool. We get to create custom plans for each one of our clients.
Yeah, I didn't realize that the rates were that low. So low fives to mid fives for a VA loan. Interesting. Yeah. And the debt to income ratios, is that different very much for conventional versus VA?
You know what? There is no VA debt to income ratio. Doesn't exist.
So what are the actual qualification purposes other than being like a veteran?
To make sure someone has the ability to repay.
Got it.
That's the biggest thing, right? We're making sure that someone has the ability to make that payment, and there's just more flexibility because veterans have a different situation.
For sure.
So here again, can I show you, Jason, my screen if you don't mind? Love to share one more screen if I could. And I'll do that right here. So here's an example of VA rates today. So again, in our example we shared, they were getting a rate of 5.625. In that example, they were getting a what is in green, you think, Jason? What do you think that 546 means?
For those who follow the channel, you know that I'm a inactive CPA, so, right? I see debits and credits here, right? So you get a credit for $546.81.
That's correct. So this borrower, this client, this real scenario we have is getting a loan for $545,000 at 5.625% with no points, and they're getting a credit back of $546 in addition, and they are basically only having to pay the title and escrow fees and some small prepaids to close this transaction. And you can see I could have gone up to 5.49 or 5.375. All these options are available. I could even get in 4.99%. So what we do in that example is we look at the break even to determine what's the best rate to get. So if I took 5.625 and looked at it compared to 4.99, which is at the top of the screen, I would see that that difference in cost is about $8,000. So I take $8,000 and I divide it by the savings difference. The savings difference is exactly $214. I see that math in my head. So 8,000 of cost divided by $214. That means my break even is 38 months to break even. That is too long of a break even.
Yeah, it is.
So that is why the consumer chose 5.625 to go with, because they believe that if refinances happen down the road, rates will go lower. So it's not worth them spending extra money today to get that rate lower for free, possibly.
Yeah, I'm not seeing a whole lot of people who are paying for points right now because people think that rates are going to come down in the next couple of years. So why would you pay $7,000 in which you're not going to break even from that out-of-pocket expense for 3 years from now? It doesn't make any sense. All right,
Yep,
Jim.
exactly.
Thank you very much for all the insights. And we'll provide a link in the video description below if you guys want to schedule a call with myself and Jim, or just Jim, if you guys want to do a confidential call with Jim. Jim's been a loan officer for 75 years this year, so that's pretty amazing.
I'm like Benjamin Button. I just get younger. But thank you, Jason, for always having me on. Now I've doubled my YouTube channel audience. It's not a big number, but it's still, I look at small wins. So I love your support there too. If you're interested to learn more about this stuff, I'm available on YouTube. Jason and I will be doing some more shorts, which are shorter versions of our content. So you can get a little more sample sizes on a more regular basis. Because obviously it's really cool to see how many people on your channel, Jason, are tuning into you at 6 a.m. with their cup of coffee, listening to your show to learn more about what's happening. And really cool, really cool.
It is cool. I mean, building basically a community of people who want to learn about the housing market. It's so cool. Yeah, it's a blessing to say the least. Yeah, and you have grown your subscriber count by double over the past month or so. So hats off to you, man. That's awesome. And I'll provide a link, of course, to Jim's channel. I'll tag you. Anyways, thank you everyone for watching today's video. We appreciate it so much. If you guys got any value out of today's video, then please hit the like button. Also consider subscribing to my channel, of course, to Jim's as well. Have an amazing day and look forward to seeing you on the next video.